Stocks recover, but the sentiment remains clouded by uncertainty. Metals and healthcare lead the rebound, while IT and consumer durables drag.
Tata Motors rides optimism following the launch of its attractively priced Tiago electric model, which some see as a key contender for the top slot in the EV segment.
Pharmaceutical stocks make a comeback as fears over a big cut in the US generic prices recede and big drug opportunities open up. Some like Torrent Pharma also get a boost from positive news.
Nykaa jumps after it plans a bonus issue. Godrej consumer gains after it looks to expand its Africa portfolio. And Tata Chemicals leaps as analysts eye gains from the China +1 and Europe +1 moves.
Hello and welcome to a halftime report. I'm Ekta Batra. We have an anchor missing today. It's only Sonia and me taking you through the next 1 hour. And it's turning out to be a session where, yes, there is some amount of optimism in the market. But remember that we did see a lot of volatility take place in yesterday's trading session after that recovery that we saw at the start. So let's see how the second half pans out. But remember, now the big cue will be what the RBI does and announces tomorrow in terms of its policy. Yes, a rate hike is in line with expectations, but the commentary, how hawkish is it, is going to be something that the street will take cognizance of. Hi, Sonia.
Hi, Ekta. Absolutely. And, you know, I think the market has sort of priced in a 50 basis points rate hike already, right? Even a cautious commentary from the RBI, something the street is perhaps bracing itself for, and hence the market is not too perturbed today. Of course, there's been no recovery after 6 days of selling from FIIs. Today, the market continues to sort of tread in cautious terrain. The bank Nifty is in the red. And as you can see, the Nifty Bank, in fact, has now moved to the low point of trade. So we've given up all of our morning gains, and it seems to have moved from a buy on dips to a sell on rally market. So that is one thing that perhaps the market has to reckon with. But let's do one thing. Let's talk about individual stocks as well. Tata Motors is the stock on our radar right now. Remember, Tata Motors yesterday launched the Tiago EV, the electric vehicle. It's the first sub 10 lakh electric vehicle from the Tata Motors stable, so there's lots of excitement over there. And brokerages are very bullish post the new launch. So let's take you through a couple of views. This is the Tiago EV has been launched at a starting price of 8.4 lakh rupees. Now, Jefferies has a buy with a target price of 540. They say that Tata Motors launches Tiago at a reasonable price and they're looking to expand their EV portfolio. The availability is now in 85 cities. They're looking to expand it to 165 cities. And electric vehicles now currently forms just 8% of Tata Motors passenger vehicle volumes, expected to gain quite a bit, the potential to gain more market share as EV penetration rises. Nomura has a buy with a target price of 520. They say that the Tiago EV has the potential to become the best-selling electric vehicle in India. The total hatchback segment currently sells 44,000 units per month, and the economy hatchback accounts for 50% of that. And the Tiago EV is expected to sell about 3,000 to 5,000 units per month. So the overall EV sales will touch 60,000 units in FY23 and 96,000 for FY24. So both these brokerages, Nomura as well as Jefferies, are very bullish on the new launch, and hence the stock is also holding up in the green.
And how much would it cost?
It's, as I said, the introductory price is 8.5 lakhs.
And it's then when you add on, how much does it eventually
I guess, you know, eventually it'll be about 10-12 lakhs, but it's the first sub 10 lakh EV. And now we're getting into this, you know, this era of affordable electric vehicles. So that is what will really boost penetration of electric vehicles. So far, the battery was the most expensive cost, but now Tata Motors, Mahindra have been able to bring down the cost. And I guess this is a big breakthrough, you know, in the penetration of electric vehicles.
Okay, so definitely for Tata Motors, but I'm tracking a lot of the pharmaceutical stocks today. That seems to, in fact, be bucking the trend. Torrent Pharma is buzzing in trade. This is on the back of a news update, which is the Indra facility of the company has been inspected by the US FDA. Remember that we put out the news that the particular plant is getting inspected just a couple of days ago. Now, the US FDA has issued 3 observations to this particular facility after the inspection closed. Why is this important? Is because I'll give you a bit of a background to understand this better. It was first inspected in April 2019, after which it was issued 4 for observations. Then that April 2019 inspection turned into an official action indicated status in August 2019, which was then escalated to a warning letter in October 2019. So that means that this particular plant had a warning letter which it had to resolve. And we don't know what the 3 observations contain, but the possibility, the street is probably hopeful that yes, there are 3 observations. So maybe there could be some light at the end of the tunnel in terms of resolving the warning letter. Now, remember that Torrent Pharma has their Dahej as well as their Levittown facility, which is under a warning letter since 2019 as well. Totally 3 facilities, including Indrad. So the street is watching for what could happen with Dahej as well. My sources tell me that an inspection could be around the corner for the Dahej plant. Remember, for Torrent, this is important, Sonia, because, you know, their US revenues shrank to almost 10 to 12% or 15% of sales as compared to 20% simply because they could not get approvals from these facilities.
Okay, and what about Lupin? It's trading in the red. Lupin received a US FDA warning letter for its Tarapur facility. How, disturbing or troublesome would that be for investors?
Well, it is definitely disturbing, but you see, you know, Lupin itself has corrected so significantly on a year-to-date or from its 52-week high. So maybe a lot of the negative news is already factored in, and the street is waiting and watching for one of their key approvals. But I'll get to that in just a bit. The news for Lupin is that the Tarapur plant has been given a warning letter by the US drug regulator. It was inspected from 22nd of March till the 4th of April. At that point in time, it was issued around 4 observations. Now, the company has said that, the warning letter will not impact supplies. Existing revenue from the facility continues. They will work with the US FDA. And the street was probably anticipating that this particular plant might not come out of the woods simply because they had received an official action indicated status in Jan 2020. So the stakes are always higher when you already come with a regulatory issue on that facility. Now, just want to put it into perspective that, it hasn't been all that bad for Lupin. It's been a little patchy, but it's been good for 2 of their plants as well. Goa got cleared in December 2021 after it was issued a warning letter in 2017. Also, their Somerset facility received an establishment inspection report after receiving 13 observations recently. But a large number of plants still remain under the regulatory scanner for Lupin. So let's see what the outcome would eventually be for them.
Okay, so that's on Lupin. It's literally halved in the last 12 months. If you look at it, a year ago, it was almost at 1,200. And now the stock is at 657. So been a big wealth destructor in the recent past. But Godrej Consumer Products is in focus. The company gave guidance to investors about their Africa business. Mangalam is here to get us the details. Mangalam, over to you.
Well, the reason why Godrej Consumer is in focus is because they held a conference call with investors over their Africa business. The key takeaway was broadening portfolio of products that they have to offer in Africa will be the next leg of growth. Remember, the business has grown in double digits over the last 8 quarters. So that is something that has the brokerages excited. We have comments coming in from Jefferies, Credit Suisse, and Edelweiss, as well as Morgan Stanley. All of them having buy overweight ratings on the stock, with target prices ranging anywhere between 975 odd rupees to over 1100 odd rupees as well. But apart from Africa, the next half of this year, the second half, we do have lower palm oil prices and festive demand as key triggers for the company. The only important things to watch out for going forward will be how they improve their Indonesia portfolio, the business out there, and household insecticides, which has been a bit of a problem for the company for the last many quarters. So if they improve those 2 parts of their portfolio, perhaps, the street would like it even more. And which is why also, the stock trades at a bit of a discount to all the others in the FMCG space at around 37 times FY24 earnings.
Okay, all right, Mangalam. Thanks very much for that. But the other segment which seems to be buzzing around is specialty chemical stocks, which are in focus on the back of a Morgan Stanley note. Nimesh is here with the details on this note.
As you rightly pointed out, a big reaction to the specialty chemical stocks on the back of a big report from Morgan Stanley. The biggest mover has been Tata Chemicals, up 7%, largely on back of Morgan Stanley double upgrading the stock to overweight from underweight, and there they've sharply raised the target price to 13.19. On the other side, they have double downgraded Aarti Indices to underweight from overweight, and they've cut the target price there to 685, and maybe that's the reason why that stock is down 2%. The other downgrade came in Deepak Nitrate from equal weight to underweight, And Deepak Nitrite, they've got the target price to 1732. SRF, remains the top pick in the specialty chemical space for Morgan Stanley, and there they've sharply raised the target price now to 35.71. So big upgrades and downgrades in the chemical space. Now coming to specific companies on Aarti Industries, the downgrade is largely because it's reflecting raw material constraints and slower project ramp up for Aarti Industries. So that's the key reason for the big downgrade. On Deepak Nitrite, Morgan Stanley sees a limited visibility on phenol and demand risk in key segments. That's the reason why they've downgraded notch to underweight for Deepak Nitrite. However, the biggest upgrade is on Tata Chemicals, and that's largely because of limited tightness in the soda ash segment, as well as the fact that the company has been doing cost controls, and that's where a big upgrade has come on Tata Chemicals. Overall, for the industry, Morgan Stanley is seeing a $25 billion value creation opportunity over the next 3-4 years until 2025. And while all these companies will not only benefit from supply shift from China, but also these companies will benefit now from Europe One, because there's going to be a lot of shift to the Indian companies from Europe. So that's the key reason big upgrades have come in. For the next 3 years, Morgan Stanley is expecting a 22% profit CAGR for all these chemical companies, despite the fact that there's going to be some demand slowdown, and some key products will be under margin pressure. Having said that, the two big reactions is on Tata Chemical, a double upgrade, and on Aarti Industries, a double downgrade from Morgan Stanley.
Okay, staying with the chemical space, higher commodity prices have hit the chemical businesses. Earlier today, we spoke to Ashish Bhandari, the Managing Director and Chief Executive Officer at Thermax. He was sounding a bit cautious about the business opportunities that Thermax is looking at because of the current global scenario. So let's listen in to what he had to say.
On the inquiry side, for the past 4 quarters, we've been reaching one high after another. Yeah. Now we have reached some sort of a plateau, but that plateau is not a kind of a recovery back to 2020 or anything like that. Yeah, the plateau we are talking about is at a high relative to what we have done in the past. We haven't had a single big order to talk about, which we would announce specifically to the street. Despite that, we should have a decent quarter on orders and a decent pipeline going forward as well. Our market share is 4%, 5% in the developing markets we are talking about. And US in particular has been an area of focus for us. And so our story is not driven by slowdown in those markets. Our story is entirely driven by market share, our ability to address certain applications, enter those markets. So that story stays intact. I don't think the macro situation affects us as much.
Okay, so that's the management of Thermax. But let's move on to a source-based story. Sources tell CNBC-TV18 that ArcelorMittal, in fact, has joined the race to acquire Shree Infrastructure Finance and Shree Equipment Finance, which are undergoing a resolution process under the IBC. Ritu Singh is here with more details on this story.
Well, yes, it's a surprising turn of events in the Shree insolvency case, where we've been given to understand that steelmaker ArcelorMittal has now joined the race to acquire both Shree Infrastructure and Shree Equipment Finance. Now, what really has prompted this move, where a steelmaker is interested in finance companies, is the fact that there is an ongoing legal battle between ArcelorMittal and Shree Infra over ArcelorMittal's acquisition of the Orissa slurry pipeline, which you remember is key to operating the SR steel plant, which ArcelorMittal had again acquired a few years back under the IBC. So in a bid to smooth over things on that end, it could have prompted ArcelorMittal to submit a bid to acquire the Shree group of companies. Now, as of now, lenders had invited fresh bids from both of the existing suitors, and that is Vardhe and Arena on one hand, and an HNI consortium led by Sean Randhawa on the other hand, because in the first round of bid, there were some disputes in relation to the earnest money deposit, and now the new deadline was the 15th of October. It remains to be seen whether lenders will accept this new surprise offer that is coming from ArcelorMittal, because they had only invited bids from the existing suitors, and those were the only two at hand. But given that there's been a lukewarm response so far, it is possible that lenders may, end up considering ArcelorMittal's offer if it is compelling enough.
Okay, Ritu, thanks a lot for that. Let's slip into a quick break. But the big event is upon us. The RBI policy is all set to be announced tomorrow. A 50 basis points rate hike is what the street is expecting. More on that in a bit. Well, folks, the three-day MPC meet is currently underway with the policy decision set to be announced by the RBI tomorrow. My colleague Ritu is here to tell us what we can expect from the central bank this time around. Ritu.
Well, the Reserve Bank is expected to raise interest rates for the fourth consecutive time, and there is a wide consensus that the hike could be around 50 basis points. All the respondents to our poll said that there will be a 50 basis point hike from the MPC, arguing that there is no real reason for the RBI to opt for a token smaller move, given what we're seeing from central banks around the world. The Federal Reserve, for instance, just delivered its third straight 75 basis point hike and has shown no signs of slowing down. The majority expects RBI to move swiftly and get the repo rates to 6.25% by December itself, while some are expecting rates to hover around 6%. Now, 4 out of 10 respondents said that peak repo rates could go as high as 6.5% in this cycle, while others pegged it at anywhere between 6 to 6.25%. Inflation does remain high, yes, but it is more manageable at this point. It is expected to have peaked in April, like RBI says, and while there are risks to the outlook, economists do not expect the RBI to revise its current forecast of 7.2%. However, given that inflation has stayed above RBI's tolerance limit of 6% now for 3 consecutive quarters, the MPC will have to write an explanatory letter to the government explaining the reason for its failure to contain inflation. Now, the 13.5% GDP growth we saw in the first quarter, that was below RBI's projection of 16.2%. Now, while a third of the respondents expect this growth forecast to be left unchanged at 7.2%, the majority believes it will be lowered to around 7% in this policy. Now, on the stance, there was no real clear majority. 40% expect that RBI will leave it unchanged at withdrawal of accommodation, but half expect it to be changed to neutral, with some even expecting some tinkering in the wording. Now, the banking system liquidity slipped into deficit for the first time after almost 14 months recently, and there is generally more withdrawal of cash as well from the system during the festive season. So, whether it is an OMO or a VRR or something else, markets do expect RBI to take note of the deficit and address the issue in some fashion. The other thing markets will focus on is comments on the rupee, on whether there will be any measures to attract more dollar inflows, and lastly, any comments at all from the central bank on the global bond index inclusion will also be keenly watched.
Okay, well, a steady, stubborn inflation as well as a depreciating rupee are going to be top of mind for the Reserve Bank of India tomorrow. Thanks, Ritu, for joining in. Before we take a break, here's some great news for investors. You can now track the US market action in real time on Money Control. Just log on to Money Control website or the app and stay informed about all that matters in the global markets. Welcome back. Well, it is definitely picking up pace for the markets because we have the mid-cap index, which is now at the high point of the day, outperforming a little bit. So up around 0.7% currently for the mid-cap index. Not at the high point, but nonetheless just about picking up pace. We have the Bank Nifty also, which is inching a little bit higher, so up around 0.2% currently for the Bank Nifty. Just want to point out one particular stock before we get talking about the technicals. Sun Pharma's research arm Spark should be in focus. That stock is in focus because they will be coming out with a management presentation on the 13th of October, and that's probably what has got the stock excited. What could the entire R&D pipeline contain is something that the street will be watching out for quite keenly. But let's get talking on the technicals now. Manish Hathiramani, who is our technical analyst for the day, joins in. Manish, hi, welcome to the show. There's a lot of optimism in the market, in pharmaceutical stocks. What's your strategy?
Good afternoon, Ekta. Thank you so much for having me on the show. Well, coming to the Nifty for starters, I continue to feel the Nifty is weak. We have resisted today around the 17,000 mark and turned from there. There should be more downside pain. I feel 16,400, 16,500 are still open targets. While the optimism is intraday, I feel unless we don't get past 17,500 on a closing basis, we really don't see any upside on the market.
Okay. I'm sure at some point the market will recover, maybe not in the very near term. But what about individual stocks? Manish, good afternoon. What are you looking at either on the buy or the sell side?
Hi, Sonia. Well, there are two sell calls from my side. The first one is on Reliance, which is for a target of 2,200, stop loss of 2470. The stock has been weak ever since we broke the support levels of 2,600. Recently, we even triggered the intermediate lows of 2,365 to be precise on the back of very good volumes. The second sell is on TCS for a target of 2,880, stop loss of 3,080. Again, in this case too, we had a break of 3250, which was a good support for this particular stock. And recently, we've even broken the lows of 2,953 to be specific. In both cases, the volumes have been active and encouraging on the downside.
Okay. All right. Thanks a lot, Manish. Have a great afternoon, and thanks for giving us those strategies. Well, that's the word coming in from Deen Dayal Investments on what you should be doing in the market. Let's slip into a quick break. On the other side, we'll get you an exclusive conversation with Puneet Chhatwal, the MD and CEO at Indian Hotels. Stay tuned. Welcome back to Halftime Report. Well, the market is just ambling between red and green, but the volatility is definitely existing in the market. And the important point is that all rallies are being sold into something that we're seeing globally and now back home as well. But currencies have been in focus all through this week. The rupee, the pound hitting new lows, rupee as well depreciating. My colleague Lata Venkatesh spoke to the former RBI Governor D. Subbarao on the rupee, whether it continues to remain vulnerable and the road ahead for the Indian economy. Listen in.
Well, without going into any quantitative measure of vulnerability, what is certain is that the rupee is under pressure. It depreciated by about 10% in the last 1 year.
Yes.
It's crossed the psychological barrier of 80 to a dollar. And foreign exchange reserves have come down by $100 billion from this time last year. We know that that pressure is coming because of two reasons. First, the current account deficit has widened, largely because of the increase in oil prices. Second, because of capital outflows triggered, importantly, by the financial tightening around the world, most importantly, the hike in interest rates by the US Federal Reserve. Now, it is certainly a cause for worry, but like you referred to the previous crisis, it's certainly not 2013, the taper tantrums. There's a big difference between the taper tantrums of 2013 and the situation today. For example, in 2013, the rupee was under pressure. There was a lot of pent-up exchange rate pressure in the rupee. It was overvalued, suddenly bled. This time, I think the rupee is tracking fundamentals more or less. Again, in 2013, we had the twin deficit problem, current fiscal account deficits year-on-year very high, leading up to the 2013 crisis. Today, this year, the current account deficit is expected to be high, but it's a one-off, hopefully. And on the fiscal, there's more credibility. And most importantly, we have the buffer of the foreign exchange reserves. So it's certainly not 2013. I would also say that it is less of a worry compared to what it was 6 months ago. If you compare to, let's say, March or April, oil prices come down to below $100. Our trade deficit, which was tracking about $30 billion per month, is now about, maybe it'll go down to $20, $22 per month on the average. So it's less of a worry, but I think if this situation persists, we will become vulnerable. And that will depend on a lot of global factors as well as domestic factors.
Okay. So, I agree. I mean, at the face of it, at that time, we were bracketed with the fragile five. Now, actually, people like Ruchir Sharma are bracketing us as the seven wonders, one of the seven, along with Vietnam, Indonesia, Saudi Arabia, etc. So, yes, we are actually in the upper echelon. But, if you dig the current account deficit a little more, the extent to which crude, the incremental pressure brought on by crude was only about $4 billion. So there are economists like Somanan Chakrabarti who pointed out on the channel that from 30 we may come down to 26, 27. We may not really come down $10 billion. Services, a lot of Indians have traveled abroad, a lot of students are studying abroad. So even if you count services, our current account deficit looks like will be well over $100 billion, which means 3.5% of GDP. And since only a small bit is crude, even if crude comes down, our imports are high. Don't you think this is a window of vulnerability?
Well, certainly. There should be no presumption at all that we're going to get into a comfort zone very soon. That's not going to be the case. The rupee is under pressure, will continue to be under pressure. Like you said, this year, the current account deficit is expected to be 3 or 3.5% of GDP. The RBI used to estimate that a safe level of current account deficit for India is 3% of GDP. That was during my time. I think they got more conservative now. Now they talk about 2.5% as being the safe limit. And note this, in the 6 years leading to the pandemic, we had current account deficit at the range of 1.4 to 1.5% of GDP, so in very safe limits.
Yeah.
So we're going to get into about 3%. As I said a short while ago, if this is a one-off, it's okay. But if it's going to persist, and if it's going to come on top of fiscal deficits, which are high, not just the central government, but both the center and states put together. Fiscal deficits are still, I wouldn't say scarily high, but certainly quite high. That coupled with our current account deficit of over 3% of GDP certainly puts us in the vulnerable zone. And we're not going to get into a comfort zone anytime soon.
Okay. You said that if, given the recession fears, crude comes down, we could get a relief. If there are indeed recession fears, even our exports could come down, isn't it? After all, our imports are indispensable imports, some of it like crude and chips, whereas our exports, perhaps, like rice and textiles, are discretionary to some extent. Do you think that if the recession that seems to be now forecast by several economists actually happens, we may have a second year of current account deficit issues?
That's quite possible. The R word is upon us, and I think it's more probable, looks more probable today than it did even 3 months ago. And if there's a recession, our exports will be hit. And the exports have been a big driver of India's growth, particularly last year when we recovered from the crisis. That is driven largely by exports. So if exports are going to be dented because of recession, that's going to be vulnerability on the external front. But on the other hand, like you pointed out yourself, if there is a recession, oil price will come down. So how these two factors will play off, I really don't know. You must ask people, analysts who actually work on the numbers. But I believe that if there's a recession, India will continue to be vulnerable, perhaps more vulnerable than it is today.
Okay, so that's a macro opinion coming in there from the ex-RBI governor. Time for a short break. We'll get you more on the markets and a lot of stock-specific action on the other side. Stay tuned. Welcome back. Well, yes, definitely a little choppy and a tight range at this point in time for the markets, but a lot of broader market stocks are buzzing at this point. Say, for example, like something like a Mazagon Docks shipyard is up around 6% on good amount of volumes as well. Don't talk much about this stock, and it's not much in terms of volumes, but Marine Electricals, which is around a 33 rupee stock, is also buzzing. So up in double digits for that particular counter. And even something like a Wadi Lal is buzzing, but not great in terms of volume. So do watch out for that kind of fervor in the markets at this point in time. But talking about the broader markets, Chemcon Speciality is up 8.5% at this point in time. Sonal is here to tell us what is keeping that stock alive.
Thanks a lot for that. Well, Chemcon Specialty higher on the back of an expansion that they have announced. The company says they have commenced commercial production of P9 unit at their Gujarat complex, and the new product launched is bromobenzene, which is used as a solvent, which is used in motor oils as well. The total capacity addition will be 2,400 tons per annum at the P9 unit that the company has announced. An expansion plan, according to the company, will help foray into newer products, and also because they are getting higher demand for bromobenzene from existing customers. So this will help them in expanding their current product portfolio as well. And that is something that the street liked in their announcement today. Just to give you a perspective, Chemcon Specialty Chemicals, it is engaged in the pharmaceutical chemicals and oil well completion chemicals as well. And it is the only producer of hexamethyldisilane, that is HMDS in India, and it is the third producer in the world and largest manufacturer of chloromethyl isopropyl carbonate in the country and second in the world. So they do have some niche products, and they're adding on more in this particular product portfolio, and that's why the excitement in the stock as well.
Okay, well, this entire space is buzzing quite a bit, right? Thanks, Sonal, for that. Well, Aarti Industries is the other one. It's set to demerge its pharma business into a separate entity. Earlier today, we caught up with Rasesh Gogri, who's the Vice Chairman and Managing Director, to discuss more on this demerger news. Listen in.
Yeah, so the demerged entity will list, post filing with ROC within 60 days. So that is likely to happen around mid of October. So it will be mid of October plus 60 days. So it will list around mid of December. In pharma segment also, we are looking at 15 to 20% top line growth and also the bottom line growth. In combined, we had guided for last year we had guided for a 4,500 to 5,000 crore capex combined, out of which, chemical segment will be doing a large capex for 4,000 to 4,500 crore. And, the guidance, revenue guidance is, up for FY27 is 2.5 to 3x in terms of EBITDA. It is 3 to 4x, and profit after tax also 3 to 4x. So we are continuing our guidance for the chemical segment.
Okay, we'll step into a quick break. On the other side of the break, Manisha Gupta is joining in. She has with her Chirag Sheth, who's the Principal Consultant South Asia of Metals Focus. Do stay tuned in.
Welcome back. Joining us on the show now is Chirag Sheth. He's Principal Consultant South Asia at Metal Focus. Chirag, hi, good to have you. The last 24 hours clearly have seen a lot of volatile moves come in for the gold prices, majorly with the way the dollar index has been behaving. But you've been bearish from the start of this year, and we almost are at the prices you spoke about at $1,600 per ounce. We've done a low of $1,615. What's your sense now?
Good afternoon, Manisha. Yes, we've been actually saying this for now a better part of the year, that gold prices are headed lower. So that has obviously, turned out the way we had, kind of forecasted. And I think we still believe that the fundamentals have not really changed. I think the moves that we are seeing essentially is something that we see in a classic, market when prices have fallen. Certain news comes in and there is a bit of short covering which comes in, So you are exactly seeing the way market behaves. However, as I said earlier, fundamentals have not changed. Gold prices are still expected to head lower, and probably over the next 2-3 months it will settle around 1,600 to 1,580 kind of levels.
Chirag, when you look at the speculative positions, the shorts that have been created are the highest in 4 years. Do you see a possibility of a squeeze there? Do you see positions being winded, or do you think more shorts can be created? I mean, you're expecting another $50, $60 decline from current levels.
Yeah, so see, already I'm sure, the kind of move that we saw yesterday was a kind of factor of a bit of short covering. So we are not ruling out that there could be further short covering which would come in, which could take gold prices higher by another $20, $30. But as I said, because fundamentals are not changed, it may not be able to sustain itself at higher levels.
1580 is what you said in the international market is a possibility. For the Indian markets, with the kind of rupee depreciation that we continue to work with, what kind of support levels, what kind of a range now are you working for the final quarter of this year?
Well, as you're aware, Manisha, it's difficult for me to give a rupee forecast because we don't do that. But I think, given the fact that in the international market we expect gold prices to go lower, and probably there is a bit of rupee depreciation in the play. We may not see that kind of fall in the domestic market purely because of rupee depreciation. However, given the fact that we expect gold prices to fall by another 4 to 5%, then probably 2 to 3% fall in the domestic market may not be enough.
Chirag, while we have been speaking to a lot of industry participants and they tell us that yes, store expansions are still happening and they are launching new jewelry launches, ahead of the festivities and the wedding season. But the kind of demand that we saw in the previous year, where there was a lot of pent-up weddings and demand for gold and jewelry, is not something that they expect to be mirrored in this year or this quarter.
No, that you are absolutely right. In a sense, if you look at Q4 of 2021 was sort of a record, Q4 in that sense. And so obviously for the market to replicate similar kind of moves would be difficult. Also, I think we need to appreciate the fact that Q4 last year saw a lot of pent-up demand coming in, because weddings were postponed, so a lot of weddings took place. So obviously the similar kind of, factors are not at play. However, I think what is, Manisha, really heartening is the fact that, gold prices have come down on a year-on-year basis. We've seen lower gold prices, and that will obviously bode well for the festive season. We've already got very early reports from our travels that, there is a good start to the festive season, probably because of lower gold prices.
So that's another factor really, because, if you bought gold last Diwali, you don't really stand at a lot of gains there, and people are debating that, investors especially, that if you buy gold right now, what kind of returns are you expecting then until next year end, or perhaps in the next 3 to 5 years?
No, that is absolutely right. And if you actually look at on a long-term basis, especially from an Indian point of view, the fact that rupee tends to depreciate 2 to 3% on an average, so obviously an Indian consumer will always stand to gain. Also, if you look at a long-term, Manisha, perspective, what we believe is that probably, gold prices should start going up by 2024 once Fed, starts cutting interest rate, and that's when gold prices could actually go up. However, next year we could see a bit of a sideways movement in gold.
So what are you looking at as a range for the next year as well? I mean, I was reading some reports and most believe that it is really going to be between 16 to 1680 on the higher side as an early forecast for next year as an average.
Right. So we basically believe that, we could see $1,500 as well for next year. And that's where, gold prices should ideally settle down because our sense is that Fed could actually stop raising interest rates by end of this year or early next year, and also the fact that you would have inflation under control. So real yields might be positive. That could be on gold prices. But once Fed starts giving, indications of a further cut in maybe 2024, you will see a bit of, positive uptake in gold.
So Chirag, as metal focus, what are you telling investors? Buy gold, but buy them less this time around in this festival, because next year you could be looking at even cheaper gold prices?
So I think as metal focus, we've always mentioned, especially in last 1 year, we believe gold as a portfolio diversifier would work well. Gold will perform some of the other asset classes, and that's why we believe that one should have gold in their portfolio.
Okay, one should have gold in their portfolio. 50,000, right? I mean, on an average is the price right now. Well, you never know. Maybe you could get it cheaper, as we were discussing. But this festive season, let's see how demand for gold picks up or not. But for the market, just take a quick look at what's happening there. The market has been off their highs in a big way. In fact, the Bank Nifty is now well in the red. So it's a complete slide from the start of trade. We have not been able to sustain any of our gains. And the Bank Nifty is now inching towards almost a 150-point cut. So true to form, there was a bit of a relief rally, but that eventually got sold into, as has been the case for the last 5-6 days. But as we wrap up the show, we leave you with some market opinion from Nilesh Shah of Kotak Mahindra Asset Management Company, who says that there can be near-term challenges for India. So in the shorter term, he's a bit cautious. Business Lunch will take all the action ahead. Thanks for watching Halftime Report.
Extent of outperformance could narrow down. There is a massive global sandstorm blowing out. We are like an oasis in the desert. But if sandstorm passes through us, some sand will be deposited. So I do believe India is in a better shape vis-a-vis others. We have some challenges like our external position to take care of. But once the sandstorm is over, that India is truly an oasis in the desert. Best thing for investor will be to buy on dips. we are indeed an expensive market vis-a-vis peers on a 1-year valuation. And we are indeed a cheap market vis-a-vis peers on a 5-year valuation. So be a long-term investor, use this correction as an opportunity to build your portfolio, albeit with a longer-term horizon.